is our Saturday again, 3 p.m. It is your time, my time, and we're here to learn something. You know, during the tax season, obviously we talk a lot about 2024 because we're doing 2024 tax return as we speak. So whatever 2024 regulations, tax code, we have an answer because we know how that would do. And obviously 2025 is a brand new year and we have a new residence in White House. So policies and campaign promises are needing to be fulfilled. So with that, we knew that it's a year of change. We knew that it is happening, right? So, but you know, our business owners often sit here goes, so what does that mean to me? You know, now I'm in 2025. Should I be doing something already right this moment? Because, you know, by the time the White House makes decision in October, it's already the end of the year. And do I buy property or I don't? Do I do this or not? So there's a lot of questions like that coming on. So this webinar I have here is just to answer that question. Tell you what is about to change, should change, was talked about during the campaign, it will change. So we make a list of that. Then we talk about how that change would come in, rolling in, how we would respond to that from a business owner standpoint. So let's take a look at our PowerPoint. Obviously, it's a guidance. It's really a guidance for me to not go off the tangent and don't know what I was talking about and really sticking with what I have and kind of give you what I know based on a certain point, right? It's a conversation, it's a dialogue, even though I cannot hear you, but I felt like I hear you. I talk to enough clients. I know that is what's in your mind, and I hope that after you go through this time with me on my webinar, you subscribe to the channel and you give me a thumb up when you felt I spoke right to the point. This is exactly what you need to know. All right. So our second slide, it is a picture of our website. So our website is communitycpa.com. And when you log into our website, on the top, these 5 buttons, the first 2 is about contacting us. If you are too busy, say if you've been watching our webinars for the last many years and you already know us and you're ready to become our client, you go to onboard with us. There you can create your own. You create your own login and you can start uploading you can start uploading your document. Here on our side, we get notification. We say, oh wow, Jeff is here. So we will take care of your files, make contact with you, know why you are here because you write us a note. So all of that is giving the convenience of you. Don't have to abide by the 8 hours working days. And our firm has 6 days working days, which is already 1 day more than other firm, but still you don't have to abide by the hours. Just do whatever when you are awake, right? Then we also have this appointment button where you can get appointment with the partners and start having them answer your questions. Our other website, really important for you, is a really convenient place for you to find things, find answers, and be smart. So this is where you come. That is our YouTube channel. Community CPA is the name of the channel. You come over here, if you subscribe, every time while we push out new webinars, like today is 2025 tax changes, so needed to know, and you would come online to actually follow us. So this is the place that you can find all of our histories. You know that magnifying glasses right in the middle of the page. If you type in what you want to know, you will find the videos that related to it. We have more than 1,400 videos in there, and we, obviously we're gaining subscribership quite rapidly. Can not as fast as I want, but it's about 100 to 150 per month right now. So hopefully we keep that momentum. It adds up, right? Where our side, we don't do advertising to get people just come in for fun. It is really a place where your face is straight, your spirit is high, and you're learning. It is not something like you come out for fun. We are very boring people, just like really no accounting taxes. And I often hear people asking me, "Oh, Ying, what's your hobby?" So I'm thinking and thinking again. Don't want to say that I don't have any hobby, but I want to say that maybe my hobby is to just get to learn more and to share more. Maybe that is my hobby. Because I couldn't think of something like golfing, something like quilting. I couldn't think of anything like that. About our firm, we are 20, actually, here says 26. Old information. We're here for very long already, about 30. And we have 5 different branches. So today I'm at Houston, Texas. This is our newest one from last July. So we are setting our route in Houston, getting connected with community, and we are very selective in terms of making biggest impact to the client coming into the door. So we want to have those clients that it is our specialty. It fits what we provide. So that's how we are moving along in the Houston community. Of course, everything we do here on webinars, it is a free knowledge for folks, for everyone. And when you decided to use these knowledge, folks, I really want you to understand, you don't just go for a website, clip certain information, use that as your backup, because they are not so-called authoritative. Like even when you call IRS, right? If the IRS agent was giving you wrong information, then you did everything wrong, and then it is your mistake. Unless you actually wrote down the IRS employee's ID number, you actually documented the conversation that may be presented to the tax court as one of your argument. You can get away from penalty and interest, but you still cannot get away from tax liabilities. So this is where I just want to say that once you know you are seriously need that help, you want to engage the professionals so they have this relationship with you. They're responsible for what you need to know. Now, let's get to our list. So I quickly listed these 4 items for the corporation. So those are businesses, right? So for the corporation, we have a tax rate to talk about. We have interest expenses deduction to talk about, tax bonus depreciation, and R&D. These are very large items for the corporation, but it's so okay to understand. I know a lot of our small businesses, if your annual sales is less than 30 million, and maybe you don't really get involved with the interest expenses side of things, but every small business would touch on bonus depreciation, touch on the rate, and you would touch on R&D. Maybe you don't know how to use it, but you would definitely touch on that. So those are the things I wanted to say that this is just a screen to summarize what I'm about to talk about, but I will lead you through examples, calculations. My job today is to make you use these knowledge, because you know that it's coming, so you know how to act towards to your next 10 months, right? C corporation rate. When we say corporation rate in here, when new administration was talking about the rate, dropping the rate, they are talking about C corporation. So in the U.S. tax structures, and you understand we have a sole proprietor, then we have LLC, we have S corporation, we have a C corporation, right? So at some point of time, people move to C corporation, or they establish their business in this way with a C corporation due to circumstances. For example, if they have a foreigner as an investor to be a shareholder of a company, they will stay at C corporation, not S corporation, right? Not LLC. So if their business is large enough, their revenue is over $250,000 net profit a year, then we would always recommend the taxpayers to move their business from whatever entity they had into a C corporation. But of course, there's a qualification to be in the C corporation as well. But what I want you to understand is the U.S. tax structure is not something like you are in a structure you cannot change. It's so fluid, you can change. You can have one EIN number, you move yourself from LLC to S corporation to C corporation, or you revert it back to S corporation and you revert it back to C corporation. So there's so many things you can do, right? These are all tax election work. Those work, of course, you want to be done right and professionally and necessarily, right? You need to do that. You need to do that. But what I'm trying to say to you is your EIN number and your business license doesn't need to change. And your credit card merchant account doesn't need to change. You just need to do elections if you want to move the entity around. So here, right now, as we speak, we're filing 2024 tax return, right? So when I file a 2024 tax return for you, the corporation tax rate is 21%. This is the federal rate. The state rate is all different. We're just going to leave the state out in this conversation. We say the federal rate is 21%. That's what it is, all right? So what Trump proposed, the new administration said that they will lower that down to 15%. So you see that calculation. If we have $100,000 net profit, right now you're paying $21,000 taxes, okay? But the new proposal to be promised to start in 2025, it will be 15%. Of course, there's a little bit more details, and it says that only for domestic company, and we take a lot of small points out, but I want you to just kind of follow me on the big senses, right? I myself, when I try to get to understand something in the very detail, I must have a higher level picture because I would not be able to think through it to the detail. So I felt like my clients are the same way. When I tell my clients that, oh, your tax is going to be $15,000, and it used to be $21,000. And I don't think I am doing the right job for them, even though they go, oh, thank you very much, it's $6,000 saving. But my client wants to know, how did you wave the magic wand, got $6,000 here for me? I want to know why. So what I always would say to our client is that last year we were under the old tax code. It was 21%. But this year, since President Trump came into the office and he had changed the tax code, Congress enacted a new tax code to allow us to take a 15%. That's why you saved $6,000. So giving the big picture, right? Giving the big picture, then come down to the result. That's what I'm gonna do today for you. So what should you be thinking? Now you know that the rate might go down, very likely. What do? If I were you, I examine my business structure. I want to figure out whether there's any reason my business should be changing the structure to take advantage of the 15%. Because you know, there are people saying that, oh, Ying, you're wrong. There is a double taxation. You know what? If someone say to you that, oh, don't go there because it's double taxation, it's because their vision, their tax planning, their understanding of tax code is so limited. They did not know what they are talking about. Yes, there is a double taxation. That is absolutely correct. But if you are a privately held company, not a public company traded on the New York Stock Exchange, if you're a privately held company and you get yourself into the situation you are paying a bunch of dividend tax, I think you need to change your accountant. Just very simple. And that should not happen. You have a lot you can do within the corporation. All right, I'm just talking about small businesses, right? If I do Elon Musk's tax, maybe, you know, he has to pay a lot, but I don't do his tax, and I don't know all of these. Amazon loses money every year. I don't know how their accountant doing. They shouldn't be losing money, but they do. So there's a lot of things that it is so outside of me, and I don't have any interest to really comment on that. But for our small business owners, know that. And you should not. You're driving a Toyota, you're working 24/7, and you don't even have time to shop for your own clothes, and you dress shabby like the homeless guy, and you just work, 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 right? And you're sending your kids to Harvard. And I have seen those kind of people. You should not pay dividend tax. You don't have it. And you really is the kind of parents, the kind of business people that need a lot of care to keep the money that you should keep. You just don't belong to the paying tax elite group, okay? So that is where I say that you want to consider your tax structure. Maybe it is time to change. Interest expense. I know not a lot of people are small businesses. When I say small businesses, I am talking about people making less than $30 million a year. So there is a threshold saying that if your last 3 years, like 24, 23, 22, if you add these 3 years together and your gross receipt, like your total sales, is over 30 million a year, then you have this issue. But if before that you don't have this issue, you can elect to be exempted from that. Okay, so just know that small business have much more flexibility in how they handle the interest expense deduction. Okay, the election they file to go away from this limitation, that election form, it is not something like IRS has established a form for you. It is really something that you have to write. You have to write to IRS, then attach that to your tax return, submit. Then you will not be limited to this interest expense limitation. Interest expense limitation just means that if you have $100 interest expense, you are imagining that you're just going to reduce that out of your income. You don't pay taxes on that, right? That's what you're thinking. But when you get into a certain size, that doesn't apply to you anymore, and you would actually deduct less. So let me give you this example, because this example would kind of hone in the knowledge I want to translate to you, and just bear with me, okay? Bear with me. So of course the example I'm using small dollars, they're actually normally are big dollars. So I'm just saying that assuming thousands, right? So let's say in the year your business got interest income for $1,000. Then interest expense for $1,200. And adjusted taxable income. This is a very technical term and has a lot of knowledge in it. So in this case, let's just assume we know what is adjusted taxable income. So that adjusted taxable income calculation equals to that adjusted taxable income equals to the 100. That 100, it is the net income you got for the year. you know how you normally do your taxes. You got total sales minus expense, cost of goods sold, and you got $100 net profit, right? So you take that 100, you minus 30% of that 100, and then you got $30. So that is your $30. That is, oh, actually, that's your $70. I actually did a wrong calculation right there. What am I doing, right? It's a 30% of your calculated adjusted income. So in the old way, like right now, that $100 included the depreciation $25. But what the president wants to change is to say that don't include the $25. So the difference between included or not included, it is just to give you more deduction versus give you less. So if you included the depreciation, then it would, if you not include that, it will give you more deduction. If you include it, it give you less deduction. So the sum of a number which going to be used to compare to your interest expense, that sum right now is 1,005. Whichever is less, it's become your interest expense deduction. So in this case, you kind of think that, okay, there 1,005 is less than 1,200. That means instead of deducting 1,200 for my interest expense, the company only can do 1,005. So this is where the calculation comes in. It's called 163J. So that is the tax code. This code is representing the calculation of interest limit you don't have. You cannot deduct it all. It is very similar to what, folks? You may already knew. It is very similar to the home mortgage deduction we have on Schedule A, right? Because they don't allow you to have more than $1 million loans. That interest, they lower your interest expense. You can't deduct it all. So the new administration proposed that to ignore about the depreciation, don't take the depreciation out, leave it in there, so they would have a bigger calculation, right? So then bigger calculation will bring a bigger amount, then your limitation will be less. You can deduct more. Basically, that's what they're doing. So when we talk about this in general, what does that give you? What does that mean to you? We just want our small businesses, when you are growing your practice and you're growing your business, you really want to be aware of whether you are in that exemption group or not. If you are in that exemption group, you want to elect yourself to be out of this limitation. There's two categories of small business can elect it out. You can choose. You can either choose to use the small business exemption, elect to be treated as a real property trade or business to avoid that limitation. And this would, you need to elect yourself to be a real property trade or business to go away from that limitation, or you are identifying yourself as exempted, period, because your last 3 years, your total gross sales by average did not go over 30 million. If you are under that threshold, this 163J doesn't apply to you, but it does apply to some of our clients because they are running bigger than that and they are subject to the limitation. So we want to be watching that, and Trump's policy is trying to give more to deduct, so the current policy is not. So that's where we want to bring you, this is one changes, what's coming up in 2025. The next one is bonus depreciation. This one has something to do with every small business. Every small business has taken some sort of advantage back in 2022 all the way to right now. Remember back in 2022, if you do a leasehold improvement, say you went to shopping mall, leased the space, and you renovated the whole space for $250,000. And what happened that year? You actually can write off the whole thing. So you can write off 250,000 and created a big loss, and that loss can be, passed through to your 1040, then offset your spouse's big W-2. Then your family was getting a big refund that year, right? That's what happened. With the bonus depreciation going down, so now we are in 2024, right? So 2024 tax return, you have a 60%. So that means in 2024, when you, let me see, when you, I hope I'm right? It's 60%. 2025 is 40. So what that means is if you do the same leasehold improvement with that shopping place you rented, and instead of 100% to write off, you can only do 60%. So the leasehold improvement is something that classified to be listed property. So certain asset can go through bonus depreciation, and that's right now is 40%. So if you buy something or if you do something in 2025, the depreciation was not really attractive, right? But the promise from the new administration is that retroactive bonus depreciation to be 100% starting January 2023. What does that mean? That means back in 2023, while we did your taxes, we were doing 80%. Now we can take 20% more deduction. And 2024, we can take 40% more deduction. 2025, we can take 60% more deduction if this promise doesn't materialize until 2026. So what does that tell us for right now? We are in 2025. You ask me that, Ying, should I expand or not? What's the status with bonus depreciation? So that is such a hard question, right? It is not something, I don't have any shortcut to reach to the top. And what I get is pretty much what in the social media and the news. So but that this is what they are trying to do. So what if that is going back to 100% in 2025? Then you want to be able to do that right away, right? Whenever that comes into law, and you want to say get going right away, and or by the October time, that is where the federal budget comes to renewal time, and then that time it is really where we can see the whole picture of 2025. We will know how bonus depreciation goes. On our YouTube channel, if you search bonus depreciation and the section 179, and I have a special webinar talk just about how to use it together. So in 2023, we have clients who take 80% of bonus depreciation, but we also use the other 20 through section 179. So they still deducted 100%. So same thing with 2024. So it is a year that you should combine section 179 with bonus, so you don't have to wait for the law to come in place for you to get 100%. So consider doing the combination first, and then if the law passed and we can retroactively do that, then we will use section 481A to retroact that into the current year. It is not like we retroact back to 2023, redo your taxes, no. And I'm pretty sure those kind of retroactive actions and would allow the taxpayer to do that in the current year. So with that said, I want you to know this is where you want to hold on to your horses and identify things you want to do. And by if you just got a good deal, you need to move forward, you know that we can use the combination of bonus depreciation and Section 179 to resolve your issue, to deduct it all for you, and or you can wait until the administration make up their mind, right? So this is where I want to say that it's very it is an area that you should involve the professionals to make sure you got the best deduction. All right, the last one on the business side is R&D deductibility. So the prior to 2022, the business could deduct 100% of their R&D expense in the year they were incurred. So before 2022. Then in 2022, this option was eliminated. So what the IRS says that, if you have $100,000 R&D in 2022, you need to capitalize it. You can get R&D tax credit, but you need to capitalize your expenses for 5 years. If it is foreign R&D, it is 15 years. So they don't allow you to deduct that all in 1 year anymore, right? So this is where the new administration promised it will allow business to go back 2022 to deduct 100% R&D. So that gives a little to do for everyone. So I know, I literally know we have a client that really should do 2022 R&D. So 2022 R&D, and it's really still doable because it's still within the statutory limitation. And as soon as we hear this, as soon as this become a law, and we will do 2022 R&D because we can deduct 100% R&D expenses in 2022 year, right? But right now it doesn't work, so we didn't even go ahead do the R&D claim for the client. So you want to know that the R&D concept, the definition of R&D, it is greatly expanded. So I want you to check with your CPAs and really understand what you do, whether that is qualifies for R&D, right? If it is R&D, not only you can get tax credit, which reverse your tax payment, and you also can deduct the expenses. Of course, right now the current rule is just kind of crazy. I didn't understand why they would even do that. It's almost like they give you $1, they take it back. It just doesn't even make any sense. But now, if this gets reversed, we can deduct the R&D expenses 100% in the year that is incurred. That would definitely be a benefit for, to support the momentum in this country for the R&D, research and development side of business. It's very critical, because if the government don't come up with policies like this to encourage people doing research, spending money, doing better things, people just don't. These are kind of things. The tax is really a tool for government to incentivize certain behaviors. This behavior, research and development, it is so crucial. It is so important to be there. So I hope that it will allow business to go back to 2022. That just means there's a lot more work we will do on the R&D side, and I'm kind of excited about that come to fruition. All right, so these 4 things are kind of related to business. So from the rate to the interest expense to the depreciation expense to R&D expense, it is all stuff that business owners should know whether that apply to you or not. On the personal side, we of course also have things that the new administration promised to happen. So one of them is the rate. So right now our income tax rate for individual is at 37, but if you remember not too long ago, it was 39.6. So if this doesn't get restated, and it will go back to 39.6. But if it is getting restated, the top taxpayer would pay less taxes. So this is more of a benefit for the top tier of the rich, right? The well-doing taxpayers. So this is a campaign promise from Trump's administration saying that they will restate that rate. Same thing with QBI deduction. This is also for business owners because QBI is qualified business income deduction. What happened is, like, you know, if you have an S corporation, you made a $200,000 profit. When the 200,000 move from your S corporation to your 1040, what you literally are doing is you actually only moved 180,000 because you have this 20% of reduction. Okay, that expires after 2025, so need to be restated. This is where I am so confident that it will stay. So I would not, when I do 2025 tax planning, I would know for sure whether the 20% is there or not. If it is not there, you know, for us, we change our strategy. We'll figure out where we're gonna help our taxpayers to save money. But you have to have all of these knowledges in your head to be flexible. Otherwise, you know one, you know two, but you don't know 20. That wouldn't help with flexibility, right? And the personal tax side, there's also another development. They call that SALT. Capital SALT cap, a capped under 10,000. That's what Trump did when he became president in the first term. I truly believe that he did that because he lives in Florida. You know why he lived in Florida? Because he doesn't need to pay personal taxes. You know, granted, he doesn't pay any taxes anyway. But that SALT, he eliminated the real dilemma. It is not, the real disadvantage is on the taxpayers who lives in the state that pays state income tax. Like, you know, our branch, we are in 4 different states. So Minnesota have a personal tax, and Iowa personal tax, California personal tax, and only Texas we are in that doesn't have a personal tax. So having said that, this SALT elimination, and Trump did say that he's going to revert what he did in the first term because there's a lot of his supporters are in these states. So if he let go of that cap, the people who are in the income tax state will have a lot more deduction on your 1040. So let's say you pay 30,000 state tax. You know, I have a countless people. I can't even count. We have 12,000 clients. So I have countless people who pays more than 30,000 state taxes. So imagine that the 30,000 would go into the Schedule A. And if you also have your other taxes, property tax and your second home vacation tax, your mortgage, everything add up together. So let's say you got $30,000 deduction. If your tax rate is at 20% or 30%, you got $9,000 tax saving. It's a lot of taxes. So I hope that will come to be eliminated. Only fair for 3 out of 4 of our branch clients. So that is something they were talking about. So hopefully it will come through. Now, Trump administration also promised other things. So not a lot of roadmap come out for that, but I don't want to forget because promise is promise, right? Promise, and if they can do. But this is not part of TCJA Act that was enacted in 2018. This is the one that outside of those existing things. So overtime and tips. You know, during the campaign time, and Trump mentioned that to exempt income tax from overtime pay and tips. Okay, and he also said that he will impose national sales tax, which is really the tariff tax, so 20 to 60%. So we will see whether that comes through, and he will impose Canada, Mexico For 25%, China additional 10. China is already 25, so additional 10 goes all the way, it depends, right? So up to 60%, some of the product. So basically, he wants to shut down anything coming from overseas and thinking that we will just do exporting, we are not doing importing. And good luck, because countries are countries. When you implement tariff tax on your land, other country implement tariff tax on their land as well for your product. So it just essentially cut off connections between countries. And you know what? In my childhood, China went through that. The Mao actually cut off everybody, right? So the China was like isolated, and you know, those are histories. History can repeat with a new characters. So we will see how that goes. And this is something that will impact personal, just because the sales tax is very personal, and everybody goes to wherever you go, you will see price increase. Right now, the 10% has already enacted on February the 1st to China. So the importing item largely on the construction materials and consumer goods, apparels, all of these things. So some of them would be absorbed by the importers, our country's business people, and majority of it will eventually be absorbed by consumer people like you and me. So we'll just pay more taxes when we go shopping. Okay, so that's where that is, our taxes. And of course, worth to mention estate tax exemption. And I kind of want to talk a little bit about here. When we talk about estate, it's kind of like a little far from us, especially for the first generation of immigrant. You have not gone through the estate process in US, so it's unknown for you. You may have a mom and a dad still live, so they have not passed and you did not see how that going through. But let me say this to you. So the estate tax has a threshold, right? So right now, for 2025, the threshold is 13.99 million. What that means is, if your dad passed away, he did not have, you add up all of his money from bank account to property, business, savings, whatever, you add it up, is not more than 13.99 million, then basically you don't have a state tax. It is like a standard deduction for personal tax return. Makes sense? So that threshold actually will expire at the end of 2025, and we are million times sure Trump will restate that. Otherwise, we go back to 7 million. You know, if we don't restate that, go back to 7 million, there will be a lot of people don't want to die in 2025 because it's after 2025, because the 7 million is too little. All right. So folks ask me, okay, my parents, they don't have 13.99 million. My dad don't have it. My mom don't have it. Even in combination, they don't have it. So what does that mean? What am I going to do with the living trust? See, the living trust don't have a lot to do with the estate tax filing. Okay? Living trust is just to list it all your parents' things, knowing who to give it to, and knowing that is you don't go to probate court and you don't need a probate lawyers, and you can deal with that internally by your attorney or by your kids, whoever, right? So living trust is not a tax tool, but of course, when you die, when both of your trust grantors die, the mom and dad, when they both die, your living trust becoming a tax filing entity. That is 1041. So I always say that the living trust die. When the living trust die, you will file 1041. But when living trust is living, you don't file any taxes. So when you file 1041, that is when you are closing your trust. That is where your threshold comes in. And are you over 13.99? If they died on the same day together, then it is about 28 million, right? 27 million, sorry, right? So that is where I want to make that a understanding connection for you, right? So don't worry about your living trust when estate threshold changes. Nobody died yet, so threshold change really don't apply to you. Apply to us a lot because we have clients. You know, we already have our 4th generation clients, so we do have client die. They do go through estate tax filing. We understand that, so we want to make sure you understand. It's not much to do with your living trust. You don't have to bring your living trust to the lawyer. Goes, what am I going to do now? You know, the threshold dropped into 7 million. Then you need to do, what you need to do is to do estate tax planning, and your living trust is still your living trust. That is just to guide you away from probate court, to give you a clear direction of how to divide your wealth, and really, you know, reducing your heirs infight if they're, you know, if they ended up to have one. All right, so the miscellaneous ones is actually the second last slide I have here. The miscellaneous are things that we knew that is coming through in 2025. It was supposed to come through in 2025, now implemented for 2026. So you just need to know that is coming in. So that's 1099-DA, digital asset. That one, you're going to receive it if you have more than 10,000 on stable coins. So the example of stable coins would be the Tether and the USD coin. And the USD, you know, USD coins is actually abbreviated as USDC, is issued by Circle, right? By Circle, known for its transparency and regulatory compliance. It backed up 1-to-1 by US dollars. So those are stable coins. And the word of stable just kind of says a packed. It's packed with something. Can be packed with US dollars. Can also be packed with gold, but I don't know anyone packed with gold. US dollar is packed with gold, right? But your stable coins are packed with US dollars. So if you have more than 10,000, you're gonna get that 1099-DA. And then of course there's NFT. That stands for non-fungible token. Non-fungible token is a unique digital identifier stored in this blockchain, and they used to certify the ownership and you know, ownership of that digital ID. So you know, the most popular one is in the digital art. You know, people would it's called Beeple, not people, Beeples, like every days. The first 5,000 days. So that is a fungible, non-fungible token that you have. So if you have this kind of digital asset, anything over $600, you will get the 1099-DA. And you may ask me that, no, now what am I going to do with that? It just says that in the Schedule D that you have on 1040, it will be reflected in here, and then the form will show you taxable, non-taxable. Then you will report that as an income, and then you can report the offset of the value, so to conclude whether it's taxable or not. So make sure that you know the 1099K threshold is actually 2,500 in 2025. So if you do Etsy selling on Etsy website, and then you sold for more than 2,500, you will get that. So those are the things we want you to be aware what is coming in 2025, right? The last but not least, I want to announce to you the deadline to claim SETC is April 15, 2025. You miss it, you miss it. You need to know that's the due date. So you want to ask me, oh, what is that? What is that? Is a compensation the government give you based on your self-employment tax in year 2021. So 2021 self-employment tax credit is claimed by filing amendment for 2021 1040. Okay, the forms involve 7202 and Schedule 3 and 1040X. So I want you to know that, and here you can see our YouTube channel, and we have that YouTube address for you. Please just go in to search that. You can just type in SETC, you'll find that particular webinars that to show you how to do that. All right, so with that said, I just want to again say that this is our website. If you go to the appointment button, you will see these partners, and these are 6 partners we have. You can tap into our resources and make appointment with us, and don't forget to subscribe to our YouTube channel. And also here you have our website address and Catherine's email address. If you have particular webinar you want Ying to talk about, and you can just write to her, so she will make sure that I come online. And this particular one, 2025 tax changes are requested by one of the client, and saying that he knows all the 2024 because there's nothing change. It's the same, but he's more worried about 2025, not knowing what to do what. So I hope that the conversation we have today kind of give you a little bit of settling, and then knowing that what is coming in, of course, is not reality yet, but most likely a lot of those would be coming in reality, I would hope. So call this number, 515-288-3188, to talk to us and make appointment however you like to work with us. And we welcome new clients, and we knew that by working with our firm, you only gain, you don't lose, because we have that deep of knowledge to help you, and we are indeed capable, and we're indeed we have competency to serve the community here. So we will talk to you again, and I will see you on Tuesday for my next webinar. Okay, bye.